Let me introduce you, Jamie, real quick. Jamie is our resident long-term care expert, and this is part 2 of our, I think it's our 2-series webinar, correct?
3 parts.
3 parts, okay. Well, just for a little housekeeping, the first part, which was about an hour long, was really a deep dive into the long-term care and One America specifically, and how some of the great stuff that they have, including lifetime benefits, which is hugely unique. I think we're going to talk today about annuities, annuity rescue plan, if you will. But anyway, going back to the first part, if anybody wants a copy or a recording of that webinar, all you got to do is give me a call here. We have it on copy. I think it's well worth the hour investment. And with that, Jamie, I guess I'll just turn it over to you and let's get rolling since I was making everybody late.
That's all right. Well, first of all, congratulations, Mike, on the recent nuptials. And
well, thank you.
So honored that you actually came in today to do this with me.
I wouldn't miss it for the world, Jamie.
You're awesome. Awesome. So recognize a couple names on here from the last session, so thank you for coming back. But today will actually be pretty short and sweet. As Mike mentioned last time, I kind of went through more of a preamble where we were setting that stage of asset-based long-term care, how it differentiates from standalone or just your LTC riders. We don't need to do any of that today. We're kind of just digging straight in to the meat of this particular topic. Now, I personally love this concept, and maybe it has something to do with I started my career as an annuity marketer. I believe in annuities. I sold my mom an annuity. When they're truly used for what they're intended for, right? They're fantastic, that guaranteed income. But when plans change, what do we do? And that's what we're going to cover today with this really amazing opportunity with One America's annuity care line. So you'll recognize this slide from the last session. I'm going to use this again because what we're talking about here is the sheer volume of annuities that are written year in and year out. Okay, I mean, just last year, well, I guess not last year anymore, 2016, $2.8 trillion of annuities were sold. And that is a mix of all different types, right? There's qualified, non-qualified, variable, fixed, indexed. They're all included in that number. But you can see, going back through the years, just how many annuities are sold. So there's, trillions and trillions of them out there on the books. You'll also remember this slide, right? That 73% number. That is the amount of annuity holders who were interviewed in 2015 in a Gallup poll that said they were going to use their annuity not for the guaranteed income, which they purchased it for however many years ago. Plans have changed, right? They're not necessarily needing that for the income anymore, so they're hanging on to it as what we call that rainy day fund. But specifically, they were asked what they were going to do, and they specifically said catastrophic illness or nursing home care. Okay, couple that with the fact that only 11% of people over 65 have any kind of long-term care strategy in place, you can see this amazing opportunity. I mean, how often do you get clients that are just literally telling you what to do with their annuity, right? Just right on a silver platter. Okay, so we do have some amazing options out there. So what makes this particular strategy so effective with One America is the fact that their annuity care products, which I will cover a little bit for you guys. I don't normally like to talk products, but most people aren't very familiar with their annuity care products, so I will cover that for you, so don't worry. But they're all Pension Protection Act compliant. And if you're not aware what that is, I'm just going to break it down in a very high level nutshell, if you will. It was passed in 2010, and all it's saying is that a non-qualified annuity owner has the ability to do a 1035 exchange into a compliant annuity that's compliant with the PPA. That obviously happens tax-free because it's a 1035 exchange. And now, if they choose to accelerate that annuity for long-term care, which they are designed to do, those benefits also come out tax-free. Okay, so in essence, what we have the ability to do here is give the client the opportunity to eliminate taxes on all of those deferred gains in that annuity that's already sitting there earmarked to tap into in case they get sick. So with the right annuities, non-qualified, it's got to be non-qualified, that's got some significant gains, that's getting close to being out of surrender, is kind of like the most effective way to do it. It doesn't have to be completely out. Those are your opportunities. And again, trillions of them out there. And it doesn't matter if you wrote it, right? I get that pushback a lot from advisors is, well, I don't write annuities, Jamie, so this isn't for me. You don't have to write annuities, but somebody else probably did. More than likely, they've got one in their assets. So it's still an opportunity to take a look at and see if the needs have changed and if you could present this to them. But just a quick little visual of how the Pension Protection Act works. So let's say you've got a client that has a $250,000 annuity that has a cost basis of $100,000. We've got, $150,000 of gains in there just waiting to be taxed. If they left it where it was and a care event happened and they needed to pull some income out of there, it's going to be taxed, right, on a LIFO basis, just like any other distribution from a non-qualified annuity would be. And eventually, there could be an endpoint to that annuity. Even if there's a doubler on, say, their income rider for care, well, that's great. Then we're pulling out twice as much, and we still have issues with paying taxes on the gains. So what these One America annuity products will do is now we're going to do the 1035 exchange into their compliant annuities, tax-free. And now when they pull it out for care, no taxes. So tremendous, tremendous opportunity. Now, I do get asked a lot, so let me just cover this, like what makes it a Pension Protection Act compliant annuity. We'd have, we could spend 30 minutes probably talking through like legal language. There is specific language in these annuities that makes it very clear, okay, that these are long-term care solutions. They are 7702B compliant annuities, okay? If you're going to try to compare one of these to a traditional income annuity or just an annuity that's got strong growth, you're going to be sorely disappointed, okay? There is cash value growth, but they're not designed to be wealth makers or income providers. These are long-term care solutions. So you've got to be able to think about it in that right mindset when you take a look at these. But for care, for those non-qualified annuities with lots of gains, they're killer, okay? So just a quick overview of the One America products. If you remember last time, we focused on those asset care products, okay? Those are our whole life insurance-based product line. And there was multiple products within asset care that you could choose from based off of your funding. But today, we're gonna focus exclusively on their annuity care lines. And you'll see that there's 3 products available. And I'll just give you a quick breakdown of those really fast. So on the left, you see that's annuity care. A lot of times you'll hear it called annuity care 1, and that's just to kind of differentiate it from annuity care 2. There's annuity care 2 as well. Those are both fixed annuities, okay? They're all gonna pay out a little bit different. Probably the biggest change over asset care that you'll see when you start digging into these is there's no choice as to how fast we can accelerate that annuity. If you're familiar with the asset care products, the death benefit, right, you have a choice. Do you want it to come out over 2, 3, or 4% per month? Well, annuity care just kind of is what it is, okay? They're gonna accelerate over a set number of months. Whether you have a single annuitant or a joint annuitant is going to be that deciding factor. Okay, both annuity care and indexed annuity care, sorry, I forgot about that little gem there. That's the one we're actually going to talk about more today. Those have the optional continuation of benefit rider, just like the asset care products. Okay, they're paid for with premium dollars, meaning you can take a chunk out of your 1035 exchange, pay it up, you can pay for it with additional money, you can pay for it in a different structure, just like the asset care products, okay? Annuity care 2 is its own little unique animal. On that product, the continuation of benefit rider is not optional. It's actually built right into the product. And how it's funded is with a monthly internal charge that comes out every month to fund the rider. Moral of all of this story is each of these products are going to bring a little bit of a different value to the table. Okay, Annuity Care 1 isn't going to have the strongest long-term care benefit per month for the premium dollar because of the fact that, number one, it's spreading out the benefit longer than the other products over 3 years. So naturally, you're going to have a lesser benefit amount, but it's going to have probably the strongest cash accumulation of all of the products in that base annuity. Annuity Care 2 is going to give us the strongest just day one leverage. And it's all about that continuation of benefit, rider, right? You don't have to pull out a chunk to pay for the rider. So 100% of your premium in the total package day one, which is going to give us the strongest day one leverage, but we can't do any lifetime benefits. So I would say that Annuity Care 1 and Indexed Annuity Care are the ones I get asked to show the most often for two reasons. Number one, they both go up to age 85. So some of those older clients out there that have some annuities that they are not going to use for income, they probably would have already if they were going to, there's an opportunity there, okay, for those clients. And even for your younger clients, both of those products have the ability to show that lifetime income. I do really love Annuity Care 2 though, as well. That day one leverage, and as you can see, we can get up to some pretty significant benefit periods, like 11.5 years. I mean, that's not small, okay? So strong products across the board. You can rely on, you know, your marketers over there at Davis Life based off of your particular situation to figure out which one makes the most sense, and I can help with that as well. So I just wanted to give you a quick little rundown of the products. So I'm going to show you an example, and this was pretty darn close to a real case. It was my inspiration that I actually helped place back in August of last year. So just kind of rounded all the numbers for you to make it easy to wrap your head around. So situation is we had a gentleman who was 75, and he had a non-qualified annuity. It was actually an old Aviva multi-choice annuity. I remember this because I used to sell that product. They weren't going to use it for income. Cost basis was just around 100,000 and some change. Okay, so he and his wife, she's 73, had no plan in place for long-term care. Their plan was, again, either to just dip into this annuity, maybe trigger their income rider with their doubler for care, and if nothing were to happen, then they were just going to leave it to their kids. So what we showed them was a joint, you heard that, a joint lifetime benefit solution using the indexed annuity care. So here's what that $250,000 got them. Okay, so they each were able to receive at least $5,500 a month for both of their lifetimes with that $250,000. Okay, and I say at least because the indexed annuity care does have growth ability, right, via the index. It has a guaranteed step-up provision, which we can talk about that, you know, at another time if you want to dig into that. But it's going to continue to grow. Okay, so these are just day one benefits. So if one person was pulling from this for care, they're getting up to $66,000 a year tax-free. Okay, and if, let's say they both, for whatever reason, were on claim and they're both pulling their $5,500 a month, now we're talking about the ability to get $132,000 out of this annuity tax-free forever, as long as they needed it. Okay, and there's not another penny of premium ever due again because we paid up that rider with a portion of that $250,000, which, by the way, also happens tax-free. Okay, so it's a phenomenal transaction that you can put on the table. So what I like to do, though, for any of my annuity folks out there, is put this into what I call annuity speak. Okay, in the annuity world, we live and die by that payout factor. What's the payout factor at this age, right? That's how you know who's super competitive. So I actually ran this by last summer, some friends of mine that are still in the annuity marketing world, and said for a 75-year-old male, what's a very competitive, you know, income payout factor? Because here's what I'm able to get. Okay, 26.4% if just one person is pulling that at that $66,000 a year. If they're both pulling, 52.8%. And by the way, those numbers, like I said, are, tax-free and forever. She said, well, gosh, that's pretty great because the most competitive I've got on the table right now is 6.5%. So that really, really helped, drive this home to the advisor that I was helping to place this case. Like, we could do 6.5 in the market right now, or we could do 26.4 or even 52.8, tax-free forever. Okay, obviously they took the app, they made the sale. Speaking of, let me cover this first. Almost got ahead of myself, got too excited. So this is what I call my wait, what slide, because it never fails. I can almost hear the keyboards typing out there, people saying, no, Jamie, that you can't do that, right? You can't 1035 exchange a single owned annuity into a joint, so you messed up. Well, guess what? That's what makes this even just more exciting than the pure value from a taxation standpoint. So what One America is able to do is add a spouse, and it does have to be a spouse unless we get a very hard to come by exception. Adding on to these annuities, that's what's called an eligible person. Okay, so here's how this works. The 1035 exchange is still showing, in this case, our husband as our sole annuitant and owner. That's how that transaction can happen tax-free. The spouse is added on as, again, simply called an eligible person. And basically, she's only eligible to receive the long-term care benefits as illustrated. Okay, it's a very important distinction to make when you're running these quotes and filling out your application. Okay, so, oh, sorry, I forgot to D&D my phone. So what's important to do here and to set these up is to make sure that your spouse is also your beneficiary. So what happens in this situation, let's say husband passes away, and these are annuitant driven, she then has options on the table. She can, take the value in the annuity and move to Tahiti, should she choose to. But if she wants those long-term care benefits in place for her, she simply assumes that annuity, keeps everything going as originally illustrated, names her own beneficiary at that time. And then if she passes away and there's any value left in that annuity, she hadn't maybe used any of it or all of it for care, then her beneficiaries have your same standard options that they would have as a beneficiary of a non-qualified annuity. So super, super exciting conversation to have with those clients. So what I just recommend doing is either, just to get started, just kind of look, right? Look through your book and see who's got some non-qualified annuities out there that look like they have some substantial gains. Ask them one simple question. Has the plan for this annuity changed? If they give you the response that, no, I need it for income, move on, right? Because again, that's what they're designed to do, and they're powerful instruments for that. I would never want to take away anybody's income. But if they give you any indication that they're going to use it just in case they get sick, probably the most common way you're going to hear them answer that, let us know. Okay, let us show you some options. It doesn't have to be this product. It can be Annuity Care 2, it can be Annuity Care 1, but let us just put that on the table for you, present that to your clients, and you'll be shocked how many people will raise their hand and want to take advantage of that. As far as an underwriting goes, that's what I got excited to tell you earlier. It's extremely easy, okay? There's no death benefit associated here, so we don't have any mortality underwriting at all. Okay, so you're taking off the table declines based off of cardiac issues or diabetes or just your typical things that might knock you out of a life insurance-based contract are not considered. Okay, so the list of ineligible conditions is like, this big as opposed to, this big on asset care. You're talking about pretty major things. Okay, cerebral palsy, multiple sclerosis, Huntington's disease. Do you already have dementia or Alzheimer's? Are you currently on disability? Those are the things that are going to knock you out. So, generally speaking, if you're declined for any annuity care product, it should never be a surprise, because there are going to be some pretty major issues. So it's a relatively quick process, nothing but a phone interview. If they want that continuation of benefit rider, they will never do an exam. They will never pull an APS. So they're quick turnarounds. Okay, so with that, told you, short and sweet. Let's see, I think I hit the time right on the head, guys. We did a good job.
Well done, Jaime.
Thank you. I know, I told you, this one's just kind of down and dirty, but I hope you guys can tell just how excited I am about this particular opportunity. And I have seen some tremendous amounts of premium come through the door, and from advisors that just want to ask a few questions, and also build it into then their ongoing initial meetings. With every first-time meeting, they are looking at those annuities and they are asking that question. And it's millions and millions of premium for them every year.
I think that was fantastic, Jaime. I think having the annuity option, certainly in the case where we have a hard time underwriting on the life side, and I see that as a huge market for your annuities as well. Your thoughts on that? Have you seen a lot of that? If we get a decline on the life side, having a real smooth, nice transition over to the annuity side?
Yeah, and it's so funny you say that, Mike, because I think for, again, I've been working with these products at One America for almost 8 years now. And for the longest time, I was just as guilty of this. I thought of the annuity care products as a pure defensive play for exactly what you just said. They're too old, too sick for anything else. Well, then we'll look here. And it's great for that. And we do have success with that. The hiccup there is you've got to have a single premium. Okay, so anything with a flexible premium is not an easy transition over to annuity care. But yes, definitely. Too old, too sick for MoneyGuard, One America, LTC rider. Let's take a look if you've got that single premium. But what got me so excited was learning about this Pension Protection Act and putting that out there as a proactive strategy to do some planning. But either way, absolutely, there's value with either situation.
Excellent. Jaime, thank you once again. I think my contact information is on there for the folks on the line. Please give us a call if you have any questions. Jaime is our expert, and we have access to Jaime anytime, even in some case design and really working with the broker and the advisor to get and the client to get the right solution. So we've got a real good asset over here, and I think we're underusing you, Jaime, to be honest with you. So get those phones ringing.
I've had built some great relationships with a couple of your advisors since our last webinar. So I appreciate that. We're getting lots of opportunities on the table for them. So yeah, absolutely. Work with your marketer, and you guys can loop me in. I'm happy to help.
Good. Thank you very much.
All right. And I don't see any questions. I don't believe.
I don't see any either. Yeah.
All right. Well, you'll probably be getting some phone calls. It usually only takes a few minutes for somebody to give you a call.
Excellent. All right. Well, we'll close her down then, Jaime. Thank you again for your help and time.
You're very welcome. Bye, everybody. Have a good day.
Bye-bye.